welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, alongside Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Right now, it looks like the soft landing scenario is very much still in the cards, and you're seeing that reflected in a lot of optimism across markets. We're watching, in particular, small cap equities, seeing, I think it's 6 straight days of gains, leading markets higher. Riskier assets are really celebrating this idea that the Fed can stave off a hard landing, prevent a contraction from happening, do it proactively before we see more weakness here in the labor market.
Remember, their demand creation budget used to be 10% of the top line. It had fallen under this, this management to about 7 to 8%, partly because there wasn't anything to get behind. So he's well liked at the company. He obviously had, positions throughout the entire organization globally, consumer, marketplace, Europe, North America. I mean, I couldn't think of a better person other than Mark Parker to come back.
Even if you enter a softer consumer spending environment, on the margin, of course, there's going to be a demand impact. We just think that the volatility of the demand impact from a weaker consumer is much lower at Apple than it would be at many other companies.
We got 1 hour to go until the market close, and we're taking a look at the major averages here. A little bit of bouncing around today, but in a pretty narrow range. So right now the Dow is down by about 13 points, but it went green briefly. The S&P 500 didn't quite make it to green, but you've also seen that similar pattern. Right now it's down 1/4%, and the Nasdaq is off 1/3 of 1%. Now, some of that sort of up and down motion today has to do with comments that we got from Christopher Waller, Federal Reserve Governor, who said he was one of those people, process of elimination. He was one of the people in favor of a 0.5-point interest rate cut from the Fed. And he talked about why, and that it was really that inflation has been coming down faster than he expected.
Yeah, so inflation cooling faster than expected, and basically telling reporters, listen, I thought that gave the Fed room to cut, shift focus to that moderating labor market. Of course, Waller and the rest of us get another look at inflation data next week, Julie, with PCE.
Yeah, exactly. But it also may be giving the market a little hope that he didn't seem as concerned about the labor side of the equation, was more encouraged by the inflation side of the equation. By the way, Jamie Dimon speaking at a conference today, and the JP Morgan CEO saying, well, he's always been, over the last year or so,
it's
a little bit less
he's
optimistic.
Been beating,
yes.
Yeah.
He says he hope it's true that we can avoid a recession, but he says he is more skeptical.
It's interesting. Dimon this has been his storyline for a while, and he's sticking with it and really kind of hitting these same things. He's worried about stickier inflation. He's talked and he's written about that because he'll point to deficit spending and remilitarization. And then on the soft landing, I think Dimon, again, kind of saying, listen, wouldn't count on it. Exactly.
Right, exactly. So we saw a little bit of bounce around on all of this. The other thing that we got to talk about today is witching, right? The expiration of futures and options contracts and options on futures, stocks, and indices. You see the VIX popping up a little bit today, but this can increase volatility. It can increase volume on a day like this.
Yeah, and then as the contracts expire, Julie, too, you kind of wonder, question becomes, okay, so how do traders, what's the next move? How do they position from here?
Once they're sort of starting fresh. There's an estimated $5 trillion in the expiration of all of those types of contracts. This happening on the same day that people are preparing for the S&P rebalancing that is going to take effect on Monday. That is, remember, Dell, Erie Indemnity, and Palantir going into the S&P 500. So anybody who indexes to the S&P is then going to move money around. So that combined
a lot going on, a lot of cross currents.
And then finally, just quickly, want to talk about the big corporate story we're watching today, which is Microsoft signing a contract with Constellation Energy to restart 3 Mile Island, the decommissioned nuclear power plant, in order to provide power for data centers. And utilities are ripping today on the back of this news.
I mean, so many themes we talk so much about, Julie, in terms of EVs and crypto and the AI boom, demand for electricity. And so, yeah, you're going to see these headlines and you're going to see this kind of broader interest in nuclear.
Yes, and we're going to talk more about it later in the show.
Sure will. All right, switching gears, Fed Governor Michelle Bowman explaining her dissenting vote at this week's Fed meeting. Jennifer Schonberger joining us with the details. Jennifer.
Hey, Josh, that's right. Fed Governor Michelle Bowman out with a statement today explaining her rationale for dissenting against the Fed's 50 basis point rate cut, saying that a smaller move would have been preferred since inflation has not yet come back down to the Fed's 2% target. Bowman saying, quote, "I see the risk that the committee's larger policy action could be interpreted as a premature declaration of victory on our price stability mandate. We have not yet achieved our inflation goal." Bowman was the only member of the Fed to dissent in that split vote on Wednesday's policy decision, saying she preferred a smaller cut of a 1/4 percentage point. She was the first to dissent in 2 years and the first Fed governor to do so since 2005. Bowman agreed it was necessary for the Fed to lower interest rates this week, but argued that moving at a, quote, measured pace toward a more neutral policy stance will ensure further progress in bringing inflation down. Bowman said that the U.S. economy remains strong with solid underlying growth and a job market near full employment. She says, although hiring appears to have softened, layoffs remain low. Now, elsewhere, Fed Governor Chris Waller says it was progress on inflation, not concerns about the job market, that convinced him to vote in favor of a 50 basis point rate cut this week. Guys?
Jennifer, thank you very much. Appreciate it. Well, for more on the latest market moves as stocks waver ahead of the close, we want to welcome in Jay Hatfield, Infrastructure Capital Advisors CEO. It's good to see you, Jay. Thanks for being here.
Julie.
Let's talk about the Fed, first of all, and the move that they have just made, which was not the move you expected, I believe, and not the move that a lot of folks expected. Was it still, though, the right move, even if it wasn't the one you expected?
Absolutely. We really just thought they wouldn't raise 50 because we think the Fed really needs to be reformed. They have a very rigid, rule-based approach, unlike Greenspan and other Fed chairs. And that has caused them, and they also slavishly focus on just one indice, which is the PCE, which is flawed because of the shelter component. And so we thought they would just stick to that framework, be bureaucrats. But I think Jay Powell is starting to worry about his legacy because they've really been totally behind the curve and they've been excoriated by people like us and others for being incompetent and behind the curve.
So Jay, this was a catch-up cut to you?
We think, well, they absolutely should have cut in July. That became obvious to everyone. Well, at the time, everybody thought it. But then the employment report made it even more obvious. But I do applaud them for doing this because it's really a reversal of course, less bureaucratic, using more judgment. Michelle Bowman saying, well, inflation is not a target, but it really is when you adjust for distortions. So I think it's very encouraging and it makes sense the market's rallied pretty hard. And even today is encouraging because this is not much of a pullback. This is like a lame, for being September, this is a pretty lame pullback.
And you didn't, I mean, this doesn't change necessarily your outlook for stocks before year end. You're still pretty bullish. You're looking at 6,000 by year end for stocks.
Right. So the other thing that I think people make things too complicated is they say financial conditions. They start, stocks and 50 other things. There's just one thing that matters. That's the 10-year bond. That drives mortgage rates and also drives our target. So you would think that we would raise our target, right? Because it just seems like we're going to blow over 6,000 and it was too conservative. But our target's based on 3.25 10-year. So we're not even there yet. We stalled out. I think we will get there. But unless we go to 3, we're not raising our target. I would just say that if we go over 6,000, it's just a normal cycle where, particularly where you have tech stocks, and it's efficient to have over valuation because it draws capital in, and we get to market first. This is why, Europe writes reports about how to become like the United States. We have an efficient capital market, and part of that is overvaluation. So I could see us easily going well above 6,000, but unless the 10-year comes down and validates that, we'll just attribute it to kind of AI enthusiasm.
How much, Jay, attention are you paying to seasonality?
So we had actually been pretty cautious and told our clients to be worried about the usual September pullback. That's why this is so wildly bullish. Like this is the pullback. The pullback is we're at all-time highs. Because what drives that, it's not just because of the weather, something like that. It's because there's not a lot of news. Now we had a Fed meeting, but now there's not a lot of news. So you'd think that people would just like sell everything and go away. But they know that these cuts are coming. They know that earnings are probably going to be pretty strong. The most likely case, about 80%, is we have divided government, which is usually good for stocks. So just the fact we haven't pulled back, which we normally do, is, I think, bullish. Because you have to kind of be a market whisperer, listen to what the market's telling you. It's telling you it wants to go higher.
We have divided government for now. We don't have a news catalyst for now.
Right.
A lot of the folks we were talking about have been saying the presidential election is not going to really be decisive for the markets. It might be decisive for certain sectors that are perceived as being more affected. But it sounds like you have a slightly different view with some caveats here.
Right.
So why are you watching the election as more decisive?
Of course, in politics, there's always talking points. So there's a talking point like, it really doesn't matter whether it's Democrats or Republicans. If we really look back, that's true. But the reason that's true is unless you have control both houses of both the Senate and Congress, and by a sufficient margin, then you can't really do much. And so it's fine. And actually, people way overestimate how much the president controls the economy. Basically, the Fed and the business cycle controls the economy. But the president's just hanging out and getting blamed for it. So,
but the president does. I mean, got tariffs, regulations. There is some power and authority there, right?
It's true, but it's very marginal. But what is powerful is changing corporate tax rates, and that's why we do have two different targets: 6,700 if the Republicans swept and they cut taxes to 15, because the regulation, it helps a little bit, but it's not that critical. But if you lower or increase the S&P earnings by 10 or 15% and increase or decrease the growth rate, that can make a huge difference. And we saw that in 2017. I mean, stocks were in fuego when that happened, and employment went up. That's a critical policy. Everything else is pretty marginal outside of that.
What's the likelihood of that, of president sweep and Congress all on one side?
Well, what we use is, we're market experts and not pollsters.
Sure.
So we use gambling markets. We don't trade in them, we just watch them. In fact, it was pretty effective. If you were watching the debate, so I started to watch it, and it seemed like Trump, to me, wasn't doing that well. But there's nobody commentating, right? So I looked, and there's certain websites updated throughout the debate. And it went from Trump up 5 to tied about halfway through to Kamala up 3. So it's pretty good real-time information. So if you do what's called the cumulative probability, there's a 12% chance of a Republican sweep, an 8% chance of a Democratic sweep, and an 80% chance of divided government. So based on that, it's perfectly reasonable to the market to keep grinding higher, because it should be good. But the Senate, it's a little bit misleading, because it's 75% chance Republicans are going to take it, but it's all Montana. So if they lose Montana, then that's the problem with odds. It's like, it's really going to be one thing or the other. It doesn't matter what you call the odds are. Like, you could say, well, the odds of the Fed cutting 50 basis points is X, but then they just do one or the other. So if we're looking at the screens, and we're on election night, and Montana's going to the Democrats, the S&P futures are probably going to get smashed, not because people are political or that they necessarily listen to my targets, although they should, but you're going to get a lot of capital gains harvesting, and so that's going to hit tech stocks, which are obviously critical. So if we do see that sweep the Democrats, again, not political, it's not like it's the end of the world like certain politicians might say, but just simply it's going to engender capital gains harvesting as it has in the past.
Let me ask you, you did mention, you touched on earnings briefly there. We did get FedEx last night, right? Considered by some to be a bellwether. Not good, Jay, the reaction, right? I'm just curious, as earnings season's coming up, what are your expectations
Well,
there?
I do think you have to distinguish between companies. We're super bearish about Europe, particularly Germany and the industrial economy there. The cappuccino economy is kind of booming. I was in Greece, and it's like you're in downtown New York. Everybody's speaking, American English. But the industrial economy in Europe is very, very weak. The only reason they're still holed up is not just because of tourism, but also exports to the U.S. And so it's very weak. And FedEx is an international company, and all those shipments are quite weak as well. And certain parts of retail in the U.S. But it's not really a read on the U.S. economy as much as the global economy.
Would you be similarly bearish on China, by the way?
We're bearish on China like most people are in the consumer sector, but we do follow oil. We have a pipeline ETF. And actually, oil demand's pretty resilient because the Chinese industrial economy is fine. Residential's terrible, and then the consumer that's affected by residential is terrible. But everybody, if they say, oh, oil prices are way down because of China, it's really seasonality. Oil prices always go down in September. Reporters don't like to hear that because it's not a very good story, but that's just the way.
Get out of here, Jay.
When reporters call me, they're like, okay, where's my next source? That's not very interesting, but it's just absolutely true. You can trade oil that way. So, it's going to bottom out probably sometime in the next month or two, and then when the travel season starts again, probably trade up to our range, about $85 a barrel.
Jay, always interesting to hear what you have to say about so many different assets. Appreciate it. Thanks for coming in.
Thank you, Joy.
We're just getting started here on Market Domination. Coming up, Constellation Energy shares are soaring after inking a deal with Microsoft that could lead to the reopening of the 3 Mile Island nuclear plant. We're going to discuss on the other side. Plus, Apple's new iPhone 16 hit stores today. Guess what? Josh Lipton was there, and we're going to be joined by an analyst later in the hour to gauge expectations for the tech giant. Plus, Eli Lilly and Novo Nordisk are fighting for new customers by lowering prices on their weight loss drugs. We'll break down the price war later in the hour. All that and more when Market Domination returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Microsoft and power provider Constellation Energy agreeing to a deal that will restart the closed 3 Mile Island nuclear power plant by 2028. Joining us now for more is Mark Nelson, Radiant Energy Group founder and managing director. Thank you so much for joining us. This story is fascinating on a number of different levels, but I want to start with 3 Mile Island, because it is sort of such a notorious name in American history, the site of the largest nuclear disaster in the U.S. Are there any concerns? I mean, in this, the stack that they're talking about restarting was one that ran until 2019 before it was closed. But what's involved with restarting and what needs to be done safety-wise in this kind of situation?
Well, there were 2 reactors. One of them melted, the other kept going for 40 years. The only reason it closed in 2019 is because fossil fuels were really cheap and the tech companies were using the fossil fuel power while claiming that they were using renewable energy from certificates in a different state and a different time. So they were satisfied with the cheap fossil fuel prices, and they refused to get in the middle of intervening to buy nuclear power to keep the nuclear plant from closing.
And Mark, just taking a step back, you know, the demand for electricity for so many of the big themes, the mega trends we talk about on this show, right? EVs, crypto, the AI boom, and maybe not surprising to see headlines like this and the more interest in nuclear. Can you just help us maybe quantify that interest in nuclear? What are you seeing out there?
Well, I'd like to think that the nuclear interest is only because it's a fascinating technology. That's why I got into it and studied nuclear engineering. I think a lot of the interest in the nuclear is because we're running out of other energy sources. We decided to make a lot of things electric. For example, New York banning electric stoves, but then New York also shut down its nuclear plant. So we're running out of power, and we're realizing that if we're going to have everybody buy electric vehicles, we have to be able to charge it from power plants that run all the time.
The problem, of course, well, nuclear has a number of issues traditionally, right, Mark? It's traditionally very expensive, even when you don't have, you know, the differential between fossil fuels and nuclear. There's the perennial concern about where the nuclear waste is going, right, and the whole NIMBY issue. There's building new plants, which you know better than I. The last nuclear plant that was built in this country in the South has not been, it was enormously costly, regulations, et cetera. How do you overcome all of that?
Well, look, the very best American design for a nuclear plant is being built in China over and over again for about 4 years or so per reactor and about $3 billion. I don't think we're going to meet China's prices for building our reactors, but we could probably do a lot better building our reactors if we do it in series with the same design, the same plant layout, and we do it over and over. Fortunately, we've got designs that are licensed and ready to go today at existing nuclear plants that already serve tens of millions of customers. And those are the plants that are being approached by the data centers. So I think to get over this hump, we have to accept that we've got outstanding equipment ready to install. We've just forgotten how to do it, and we need to do it the same way every time.
I'm curious, Mark, you know, the headline today, you know, 3 Mile Island, how many mothballed reactors are actually out there around the country?
I wish I could give you better news here, but there's not many. Only as recently as a few years ago, states like California and New York were desperately shutting down nuclear plants that we really needed, and now they're panicking because they don't have enough power. But fortunately, we were able to help step in. I worked at an environmental nonprofit where we fought to save nuclear plants from being closed by either the cheap fossil fuels or the environmentalists trying to destroy them. And we've saved almost all the ones that were going to be closed. So there's only a few closed nuclear plants we can actually bring back. And I've got my eye on several of them because we want to win those battles we lost in the environmental world.
So here our focus is frequently on where can people invest in some of these trends, right? So obviously we already have seen all the power companies doing very well this year. We see them soaring again today, not just Constellation. Where is sort of the next frontier that people need to be watching if we're going to continue to see this growth in nuclear?
I can't advise what people should do with their stocks, but here's what I'll say what I'm doing with my time. So I'm trained as a nuclear engineer. I want to see nuclear plants get built. I'm paying attention to designs that are already licensed in the US, and I'm going to see if we can't build some of those as soon as possible.
I mean, I'm curious, Mark, what are the role of venture investors in this newfound interest and enthusiasm, excitement about nuclear?
It's tricky. Additional place for venture nuclear was to help design a new power plant or a new design from scratch, or revive an old design from the dusty books from 30, 40, 50 years ago at one of our national labs. I think that might be successful. I myself am an advisor to at least one of these advanced reactors, and I'm very keen to watch it and see if we can get it to succeed. I think it might. However, I think that we also need to build the existing ones. And fortunately, I'm an advisor to a company, the nuclear company, that is one of the ways that venture investors are getting behind the idea of being a technology deployer and developer rather than inventing new reactors from scratch.
Mark, we should definitely continue this conversation another time. We got to leave it there for now. Thank you so much.
Thanks for having me.
We have breaking news now. The Wall Street Journal reporting that Qualcomm approached Intel about a takeover. However, details right now are scant from the Journal. The report doesn't have any details on then what. We don't know what the price tag would potentially be. We don't know the receptiveness of Intel to Qualcomm's offer in this particular case. We don't know if the two parties are still in discussions. Again, this is just a very preliminary report, it looks like, in this situation. However, what we do know is that Intel has been struggling and figuring out how to remake its business. And Qualcomm, on the flip side, has been more of in a position of strength.
Yeah, it's interesting. It's also coming on the very week that Intel CEO Pat Gelsinger spoke to reporters, made some big news, and kind of shook things up over there, right? I mean, and investors liked what he said. Moves like turning his manufacturing division into this wholly owned subsidiary. Julie, chip making deal with Amazon's cloud business. Announced a lot of news. Stock reacted favorably. Of course, pulled back the chart. Intel's been on a lot of pressure. In fact, we had financial analysts on the show who were questioning whether Gelsinger was even the right guy. The very future of Intel is a viable concern. Of course, when you see a headline like this too, you also immediately think about how regulators would possibly react. Trustbusters in Washington recently don't really love big tech making moves like this. So that's another certainly immediate wrinkle.
Yes, it is definitely something to consider. Also, just for perspective here, Intel, even with its declines, is still about an $88 billion company. This would be an enormous acquisition. Qualcomm's current market value around $190 billion. So, it would be huge. And to your point, that would most certainly draw the attention of regulators. So really interesting headlines. We are going to continue to watch for any more potential details on this story.
All right. Fortunately, we have a very smart tech analyst right now.
We do.
We can get his hot
Should we spring it on him?
I think so. Bob's ready. He's a vet. Apple's newest and latest iPhone is hitting stores today. The iPhone 16 line is now available to purchase for consumers, but without the tech giant's highly awaited AI features, consumers will have to wait a little longer to be able to download Apple Intelligence features as it's set to roll out in the coming weeks and months. Without this selling point for the newest iPhones, we're taking a look at demand for the tech giants with Technalysis Research President and Chief Analyst Bob O'Donnell. Bob, it is great to see you as always. Listen, we're going to get to Apple, Bob, but listen, tech. I got a headline here. I don't have a lot of details, Bob. The Journal's reporting Qualcomm approached Intel about a takeover in recent days. What do you make of that, Bob?
Well, I heard Julie saying, yeah, that's quite the blockbuster move. And thanks for having me again, Josh. Look, I mean, it would be an enormous change. I do think in the current regulatory environment, it's going to be very difficult for Qualcomm to pull it off. I mean, there is a certain logic to it, right? I mean, obviously, Qualcomm is this, very successful U.S.-based chip designer. Intel's got their own business. They have had a lot of challenges. I mean, it's hard to imagine that Intel has gotten to where they are, but they are. And so we have to accept that and figure out, okay, what is going to happen. It's not surprising to me that we've seen some people, potential suitors, come out and say, hey, this looks like a great opportunity, because I still believe in the long run, Intel has got a lot of opportunity. They have an incredibly important role to play as a manufacturer of chips in the US. And of course, there have been rumblings in the past that perhaps Qualcomm could become one of Intel's clients for their foundry, which of course would be a big deal as well. So it's hard to say, way too early, as you guys said. It would be a fascinating one. There is a lot of logic because there's not a ton of crossover in terms of their products. They have complementary types of products. Some of their products compete, for example, in PCs, but they could be seen as complementary offerings. So from a pure product perspective, it does make a lot of sense. They've both been doing some things in automotive. Obviously, they have, as I said, the ARM chips for smartphones. You've got Qualcomm's strength there. Intel's with PC in the data center. Qualcomm's done some data center stuff. So, you know, again, logically, you're like, okay, this could be interesting. But my biggest concern would be, in fact, those regulatory issues.
Well, and Bob, just to drill down on this a little bit, you know, if there was a potential workaround with Qualcomm only buying a part of Intel's business, for example, what would be you were just talking about sort of where they might match up. What would be most attractive to Qualcomm within Intel's business, do you think?
Well, the most logical thing would be their existing chip businesses, not the foundry, right? Mm-hmm. Qualcomm doesn't have experience in the foundry. So logically, I mean, my initial thought is they're going to go for the products. But you know, part of the challenge that Intel is facing is that foundry business has to stay alive. It's too important to fail from a U.S. manufacturing and tech competitiveness perspective. And it's not clear that right now it's got enough on its own. Much of its foundry business is driven by Intel's own designs. So it would be kind of challenging to separate those two, but logically, you know, if I'm Qualcomm, that's probably what I'm thinking. Unless, of course, Cristiano, the CEO of Qualcomm, decides, hey, no, I do want to get into the foundry business. But again, huge purchase, especially based on Qualcomm's current valuation. So lots of big questions.
Bob, let's switch gears, talk about another big tech name in the news today. That's Apple. Moment Apple fans have been waiting for, Bob. Those new iPhones do hit store shelves. Of course, the key question remains, Bob, you know, does the iPhone 16 series, does it jumpstart this meaningful iPhone upgrade cycle, Bob, in 2025? What do you think?
I've said for a long time, I don't think it's going to, and we're already seeing the initial results of that, right? I mean, look, there's a couple of problems we have with the iPhone. One of them is the iPhone 16 looks like the 15, looks like the 14, looks like the 13. I mean, you know, it's getting a little old in the tooth. I mean, I was kind of joking with some folks. I was at the launch event on Monday, and I had just gotten the new Google Pixel Fold. I said, I've got the coolest phone in the whole building. It was, you know, because you've got this cool foldable design. And people are getting, I think, a little tired of this iPhone design. Then, of course, there's the Apple Intelligence features. They're not shipping yet. They will be shipping, but they're not exactly knocking people out. Now, to be fair, this is not an Apple-only problem, right? We've seen some challenges when Microsoft did Copilot plus PCs, oh, by the way, in conjunction with Qualcomm, and some of the AI features there weren't knocking a lot of consumers out. So we're very much in the early days of AI, a lot of questions by consumers around the benefits there, a lot more, I think, opportunity for the business side. And Apple hasn't done a lot to talk about Apple Intelligence for business purposes. So I think there's some fundamental challenges right now. I'm still a big believer in AI in the long run, to be clear. But right now, from a consumer-focused perspective, which is what a lot of the initial Apple sales are typically targeted at, it's just not hitting home. And plus, I can't get them. And then the last piece, just to add yet another little twist to it, is because Apple chose to put all the same processors inside both the Pro, Pro Max, and the standard iPhone, all of a sudden it's like the standard iPhone is a better deal in terms of you get all the capabilities to run AI features and all this kind of stuff without needing the Pro and the Pro Max. And so that's also a big shift. So that's a challenge because now that moves the overall average selling price of iPhones down if this continues. Admittedly, come on, it's 1 week, right? I mean, let's give it some time and see what happens. But it does reflect to me the fact that, Apple made this conscientious decision to have all the iPhones support AI, which, again, in the long run is probably a good thing, but it's creating this little blip that we're seeing right now.
What about, Bob, I talked to Gene Munster, and he takes the other side of that trade. And Gene, longtime Apple analyst.
Yes, I know.
And he says, basically just comes down to the hundreds of millions of iPhones out there that are at least 3 years old. By Gene's math, it's roughly 700 million. And he just thinks, listen, that's a lot of people who are going to be ready to upgrade. They're going to like that faster chip. They're going to like the larger displays in the Pros, the upgraded camera. What is your response to that, Bob?
Well, the exact same thing happened last year, right? I mean, Apple had the same number of 3-year-old phones in theory then, and we saw a modest upgrade cycle. I think what Gene was counting on was that the Apple Intelligence would in fact trigger what they call the super cycle, a bigger upgrade than normal. But in point of fact, what we have seen over time, and it's not just Apple, it's everybody, the smartphone business has stalled, and people are holding on to smartphones longer because, again, they haven't really changed. A lot of people are saying, hey, I just don't see enough of a difference to need the upgrade. The hope was that these AI features from Apple would be that trigger for change, but it doesn't look like that's going to happen for a while. So as a result, we're kind of where we have been for the last few years, which is that means a certain number of people are in fact going to upgrade their iPhones, but there's not as compelling a major reason to change. And that's the part that I think that got missed and was over expected by Gene and some others.
Bob, thanks for rolling with everything. Appreciate it. Good to talk to you.
You're welcome, Julie. Thanks, guys.
Let's get to some of today's top trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First, taking a look at Trump Media, DJT. Those shares falling as the lockup period barring investors from selling shares expires today here. And by the way, it's down for the 5th straight session and at the lowest since this company came public through a special purpose acquisition vehicle. Donald Trump has said he will not be selling shares, but there are other insiders. And by the way, if he was selling shares, we would likely know about it at some point because of regulations, but there are smaller shareholders who could be selling.
Yeah, per Market Watch, I was just looking here, no company officials at least, or inside shareholders at Truth Social are saying have made any regulatory filings indicating sales of stock. And as you noted, Julie, Trump did say, I think that was just last week. He didn't plan to sell any of the company's stock, but you can see, obviously, stock reacting here.
Right. Well, it wouldn't be in his interest to sell the shares, right? He's the biggest shareholder. He doesn't want the shares to go down. But there are several smaller shareholders, including the co-founders of the company. And it sounds like the two co-founders owned about 7.5 million shares. Patrick Orlando, who backed the SPAC that brought the company public, owns about 8.2 million. And from what I was reading on Bloomberg, they don't have to file immediately. But people can watch the sort of volume. People tend to watch block trading, right? Big blocks of shares being moved around to try to get an indication of whether any of that kind of activity is happening.
I think the high here was 66, I believe, at one point. All right, moving on. VinFast delivering weaker than expected unaudited second quarter results. The EV maker hit with an impairment charge on net residual value of $104 million compared to the $5 million in the first quarter. So Vietnamese automaker did report a wider loss in Q2 versus a year earlier. Company execs did say the loss was mostly due to this impairment charge, Julie. Looks like revenue popped about 9%. They delivered about 13,172 EVs in Q2. That was up about 40% from a year ago.
Yeah, two things stand out to me from this report. First of all, as you pointed out, the company delivered just over 13,000 vehicles in the second quarter. Their forecast for the full year is for 80,000. So they would need in the second half of the year to ship 58,000 more of their electric vehicles in order to meet that target. So that's thing one. Thing number two, 51% of their volume last quarter was to affiliates of VinFast. So in other words, the company has Vietnamese taxi fleets that use them that are controlled by Vingroup, which is the parent company. So just over half of their sales were to their affiliates. So that, that's probably not something that investors are too crazy about.
Yeah, company's founder and CEO, who was worth an estimated $4 billion, has told reporters he's willing to bet all his money on the company's growth. Yeah, the man has a dream, William. Coming up, Eli Lilly and Novo Nordisk are fighting for customers by lowering prices on their weight loss drugs. We're going to break down the price war when market domination returns. Pharmaceutical giant Novo Nordisk releasing new data on its weight loss pill and ramping up the injectable price competition with rival Eli Lilly. For more, we're bringing in Yahoo Finance senior health reporter Anjali Kamani. Anj.
That's right, Josh. We've got some really good, interesting updates from Novo Nordisk. A CB1 weight loss pill. Now, there's a whole new acronym for you to learn because it's not GLP-1. It stands for receptor for cannabinoid. And yes, that's like cannabis, but no, there's no high from this. So let's pull back and understand that for a second. The pill did show, it's a once daily pill, 10 milligrams, showed roughly 6% weight loss. And that's kind of on the lower end, and it's also lower than what analysts expected. So that is why the results are not doing too favorably for Novo stock. We do know that this is also an area where some other pharmaceutical companies have taken a focus when it comes to weight loss. So their stocks jumped on this news, considering that Novo didn't come out with any good results. And we also remember that Lilly's oral GLP-1 was at 14% weight loss in 16 weeks. So that is really setting the standard right now, and that's sort of what it's being compared against when it comes to that. Meanwhile, as you insinuated, there is some competition heating up on prices. This is sort of a recap we saw today, covered by the Wall Street Journal, in terms of what is actually happening in the background with the current weight loss drugs, including Ozempic, which is the diabetes drug. So what we've seen is that We heard about Lilly, right, with their Lilly Direct launching a $3.99 per month vial instead of the injectable pens and helping ease access to the drugs. Meanwhile, Novo Nordisk has seen a 40% drop in the net price, that's after rebates, for Ozempic since it launched in 2017. And then Wegovy, on the other hand, that's its weight loss drug, dropping an average of 50% in rebates compared to 35% last year. So that's an even bigger price. So they're playing this game a little bit behind the scenes outside of our view. The list prices do remain the same to what we do know, so it's still in that $1,000 range, but the net price is where the action's at.
Well, and guess what? That out of view negotiation over the price happens at the pharmacy benefit managers, who have been under fire from regulators. And the latest salvo today, the Federal Trade Commission suing those pharmacy benefit managers specifically over insulin prices.
Yes, and that is one of the biggest areas where this competition and this situation started for the FTC, taking a look at anti-competitive practices with the PBMs. So what they did today was file a lawsuit against the three biggest pharmacy managers, which are pharmacy benefits managers owned by CVS, Cigna, and United Health, and those are Caremark, Express Scripts, and Optum. All right, I got them all. And then we've got the accusation is that these PBMs have been artificially inflating insulin prices over the years, and that is why the end result, the price that consumers pay, has also been extra high. And the practice is also a part of why they're looking at some of the insulin makers, and that includes Eli Lilly and Novo Nordisk, as well as Sanofi, because they have to play the game of setting the price artificially higher in order to account for those rebates, in order to then account for their profit margins. And that's been sort of the debate in the, in the industry for quite some time. So they could indeed also go after those companies, to be determined. We did see, one quick example just to showcase this, just because I had it and we had a great little graphic. Humalog, one of Eli Lilly's insulins, $21 in 1999 was the list price. 2017, it jumped 1,200% to $274.
Wow, that is above the pace of inflation.
Yes, it is, by a lot.
Yeah. Wow.
Yeah, there you go. That's it. So that's one of the reasons why we're seeing this, and we're going to continue seeing this pressure on the pricing in the industry for sure.
Anj, thanks so much. Appreciate it. All right, let's get to some calls of the day now. Sponsored by Taste Your Trade, Morgan Stanley downgrading FedEx from equal weight to underweight. The note saying that the magnitude of its earnings miss was unexpected. The stock gets shelled today. And the street reacted. JP Morgan, Susquehanna, Stifel cut targets. And then we have Morgan Stanley, which brings the pain, Julie. They cut the target and the rating. They go to the equivalent of a sell. So they expected a miss. Magnitude surprised them. Says they see structural challenges in parcel in terms of volume, price, and mix from what they call secular changes in e-commerce, supply chains, competition, and more.
And the secular change is that people who are buying FedEx's services don't want to pay as much. So they're not buying the priority service, they're buying the lower cost service. At least that seemed to be one of the big trends. Something else that Ravi Shankar over at Morgan Stanley talked about, he thinks the company's going to need to earn almost $17 in earnings per share over the next 3 quarters in order to hit the guidance that the company has put up here. For reference, what they just reported was $3.60, and I believe that the prior couple of quarters they reported $12 combined. So they'll need to get to 17 in a challenging environment, according to Shankar, and he thinks it's going to be heavy lift in order to get there.
The risk to his call, he told clients, financial engineering, a potential spinoff of the LTL business next year.
Oh, interesting.
But obviously that risk not enough to keep him even on the sidelines. All right, coming up, we're looking at how to navigate the restaurant sector with the Yahoo Finance playbook. Stay tuned, more market domination still to come. Darden Restaurants reported Q1 earnings Thursday, and while the owner of chains like Olive Garden and Longhorn Steakhouse missed on the top and bottom lines, analysts were encouraged by the company reiterating its full-year guidance and same-store sales growth at Longhorn. With just a few minutes left till the closing bell on Wall Street, we're looking at how to navigate the restaurant sector with the Yahoo Finance Playbook. And joining us now is Eric Gonzalez, KeyBank Capital Markets Equity Research Analyst. Eric, it's good to see you. I was curious, Eric, maybe just to start bigger picture here, given your coverage universe, Eric. We're always trying to get a line of sight on the consumer, and based on your coverage universe, you're looking through the earnings reports, listening to those conference calls. How does the consumer seem to you here, Eric?
Hey, thanks for having me. Sure, it does feel like the consumer is being a little bit more choosy about where they want to eat out. We've seen a lot of brands, experience some pushback from the pricing that was taken over the last 5 years. But there are some clear winners in this industry, in this market. And so, it just depends. If you offer compelling value on every day, you're going to get rewarded with traffic, and there are some clear winners out there. But at the same time, there are some brands that are experiencing some pushback.
So let's get to some of those winners and maybe not so winners in that market. And let's start with Darden, because it did report today. It seemed like a lot of you and a lot of your peers in the analyst community were kind of like not that excited about the numbers, but more excited perhaps about that Uber partnership that they also announced. They'd been sort of a holdout in partnering with Uber, and then finally said, okay, yes. And so that means people are going to be able to get, say, Olive Garden delivered to them. How big a deal is that for them?
Yeah, sure. So I think when it comes to Darden's first quarter results, I would characterize it as mixed. On the one hand, sure, you had the biggest brand, Olive Garden, which is about 50% of the profit. That has struggled with same-store sales down 2.9%. That was largely in line with investor expectations. On the positive side, you had Longhorn, which has been executing extremely well, with same-store sales up 3.7%. That was above expectations. But the bigger issue or the bigger deal out of the earnings print was the Uber partnership, and that's something that investors have been asking about for a really long time. And Darden, for a really long time, has kind of shied away from it and said they're not going to do it. They didn't really believe in the stickiness of that channel. But it feels like this could be a real incremental opportunity. And so despite the fact that, you had some softness at Olive Garden, the upside from the Uber partnership, just with comps potentially inflecting from, the negative zone to the positive zone, is a big deal for the multiple and for the stock going forward.
Eric, another name that we talk about a lot, I'd like to get your take on, is Chipotle. It's already, obviously enjoyed very nice move, Eric. It's up about 50% in the past 12 months. You say, though, to stick with it?
Yeah, that's another name we continue to like. The big news there was that they lost their chief executive officer, Brian Niccol, having gone over to Starbucks, but we still think that the strategy is intact. This is a brand that has best-in-class digital capabilities, a really strong brand position. They've got marketing, innovation expertise. Their unit returns are among the best in the business. And we just think that resilience is worth a premium relative to its peers. We're seeing they've got same-store sales drivers like menu innovation. Throughput remains, early innings, so just getting people through the line faster, and that should support multiple expansion over time. And then there's longer term opportunities in international growth. They've got automation, and then these Chipotle lanes where the new stores, they've got almost like a drive-through for the digital pickup window. So, that's one that there's a big runway for growth. They're only about 50% penetrated in the U.S. and they've got international as a longer term opportunity. So that's one we continue to like.
So to your point, Chipotle has been this sort of growth machine that's just been humming along and has been very consistent. What do they need in their next leader? Do you think they'll look internally? Do you think they'll look externally? And kind of what characteristics does that person need to have?
We think that the leader's already in place. Scott Boatwright has kind of been slotted into the position on an interim basis. We don't see them running too large of an external search. We think he's going to be named the permanent CEO. I don't know that that's going to surprise many people, but the strategy's already been written. The playbook is there. It's just for him to execute. And I think he was a big part of that strategy creation under Brian Niccol. So I think he's ready to take the helm, and we'll look for continuation of the same. One of the great things about Chipotle is that the core product, the core burrito bowl, is an attractive value to the consumer. There are many places in this country where you can you can get a chicken burrito, no guac for, maybe under $10 or just over $10. And a lot of the comparable products, call it chicken and rice, or maybe even at fast food, you're probably looking at $10, $11, maybe $12, $13 for a cava, for even sweet green. So there is a tremendous, value proposition that Chipotle offers that is unrivaled. And I think their scale and their digital capabilities and that, pricing power that they have is going to sustain the growth for a long period of time.
Eric, thank you so much for joining us. Appreciate it.
My pleasure. Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Let's see where the major averages ended the session and ended the week for that matter. We got the Dow, very little change when all was said and done, up just 37 points, not even 0.1%. On the week, we do see an increase of about 1.6%. Take it over to the S&P 500, very little change on the day as well, just in the red. Had a little blip of green in the last hour of trading, but didn't quite make it there, down about 0.1%, though still, again, up on the week. As for the Nasdaq, up on the week as well. On the day, however, down about 0.4%. And I note the week gains here, especially because obviously we had the Fed's interest rate cut this week, and we also have a positive showing for the month so far. If I have the month to date on here, which I don't think I do, but we are positive on the month. There's been a lot of talk about seasonality in September and how it's a terrible month. Typically, it has not yet been, at least not on the whole. So that's something to keep an eye on. Now, as we see this risk off, a little bit of a risk off today, we see a lot of different assets going down, but I do want to point out gold once again at record levels. So that is an exception. When we get into the sectors here and what we saw over the course of the day, weighing the most here, materials, industrials, tech, and then of course utilities, as we pointed out earlier, the big standout to the upside after we had that agreement between Microsoft and Constellation Energy for an exclusive nuclear power agreement tied to the restarting of the reactor at 3 Mile Island in Pennsylvania. And the Microsoft is going to be the user of that power for its data centers. This really going to the theme that we have talked so much about this year, just the huge growth in AI, the power needed to propel those data centers to do the training and inference of the AI models. And this is a bigger look at many of the electricity providers here, just going to equal weight it. So we see the gains. Constellation Energy up 22% on the day. Vistra also up big 16.5%. We've seen a big decline in nuclear power in this country over the last several decades. But as we talked with the guest about earlier in the show, maybe there's a little optimism that there could be some kind of a turning point. We shall see, Josh.
Julie, thank you. Markets closing the day a little changed. The Dow staging a late session comeback and closing at a new record high. Joining us now is Ron Temple-Lazar, Chief Market Strategist. Ron, it's good to see you. So as Julie was just saying there, a little change today, Ron, but positive for the month. Does that momentum continue, Ron?
Well, I think the market is well positioned to continue to gain ground over the long term and the intermediate term. I think the Fed's decision this week to cut rates by 50 basis points was somewhat unexpected. Yes, priced by the market, but most economists, including and strategists, including myself, did not think they would actually go through with the 50. I'm glad that they did. I think they effectively bought an insurance policy against excessive weakening in the labor market. Now, you combine that with a strong corporate sector, a strong household sector, good corporate earnings. This is a market that can continue to work.
What are the biggest risks at this point, Ron, to that scenario?
Well, I think the biggest risk really are, number one, the election could change the trajectory of the economy depending on, which candidate wins, what the control of the Congress looks like, and whether they follow through on certain policies each of them have talked about. I do think longer term, one of the bigger issues most investors I talk to are worried about is just the magnitude and the expected length at which the U.S. is going to run large deficits. You can't continue to run a 6% of GDP deficit and expect not to have some consequences down the road.
Ron, I'm curious, we did hear from FedEx yesterday after close. Clearly they reported stock plunged today. Earnings season's going to be here before you know it. What are your expectations for corporate profit growth?
Well, I think you're going to continue to see a broadening out of corporate profit this year. It's interesting. For the last, I think, 6 quarters, if you looked at the S&P 500, basically all of the earnings growth has been from the big 6 tech stocks. And what we're seeing, though, is a gradual improvement from the other 494 stocks in the S&P 500. So when you look, for example, at the second quarter earnings season that we wrapped up about a month ago, the big 6 tech stocks had earnings gains of over 40%. The rest of the market only delivered about 5% earnings growth year on year. By the fourth quarter of this year, the consensus is that's going to narrow down to a 21% earnings growth for the big 6 tech stocks and 9 to 10% for the rest of the market. So I think you're going to see that broadening out, which to me is a healthier backdrop for an equity market rally as we move into 2025.
And indeed, to your point, I thought it was notable this week that we saw both the S&P 500 and the S&P equal weight making new records, which was really interesting. Does that mean as an investor you want to be broadening as well where you are holding and really looking beyond big tech?
I think that is definitely the case. I mean, I'm not saying you should be shorting big tech or selling all your big tech, but on the margin, I think you want to be moving that next dollar of capital into other parts of the market. In particular, there's certain thematic areas you can look at. One is just the biggest one is companies that benefit from lower interest rates. If you look at the small cap index, the Russell 2000, it has about twice the debt to capitalization of the S&P 500. And also 45% of that debt is floating rate for small cap companies versus only 10% for large cap. So that's a real tangible example where companies will get an immediate benefit from the reduction of interest rates by the Fed. And given, obviously, that many of us are expecting the Fed to continue lowering rates, that should lift profitability as we move into 2025 for a whole raft of companies across the market. So I think, as investors, part one might be looking at things like small cap or moving down the capitalization spectrum. And then number two, I think, is looking beyond the immediate obvious winners from AI and all of the tech innovation we're seeing right now, and trying to identify the companies that are going to be able to profit from that innovation. So it's not going to just be 6 companies or a couple dozen companies globally that are going to win from this AI revolution. I think you're going to see significant opportunities across pretty much every sector, from healthcare all the way through to financial services and consumer stocks, where companies can put AI to work to reduce their cost, improve their profitability.
I'm curious, Ron, though, in that last earnings season, there was this dynamic of investors, it seemed like, starting to really push back on big tech spending on AI and raising questions about, where is the return on this investment? I'm just curious how you think that pushback plays out in the quarters ahead.
Well, that ROI conversation is one I've had with a lot of people in terms of how long can this juggernaut be sustained, right? The only way you can continue to see, A, the hyperscalers spending this much money, and B, other companies spending so much money on AI is if they start to see a return on investment. And if they don't, then the logical response is for the C-suite to basically say, hey, let's rein in that spending a little bit. And to the extent you start to see the revenue growth and the earnings growth decelerate materially, then that takes a lot of wind out of the sails of some of these tech stocks. Having said that, to the extent companies do start seeing an ROI, there's a chance they accelerate the spending. So again, I don't think it's a slam dunk that you want to be, running away or pulling capital en masse from these companies. I do think, though, it gets more and more challenging as we move through time if you don't start to see that ROI across the customer base.
Ron, thank you so much. Have a great weekend.
Thank you.
Getting back to some breaking news now, the Wall Street Journal reporting that Qualcomm approached Intel about a takeover. That report, though, doesn't have any more details than that in terms of a proposed price tag. It, of course, cautions a deal might not get done. But joining us now to help discuss and understand this story is Corey Johnson, the Futurum Group Chief Market Strategist. Corey, we just saw you yesterday. We had to bring you back today because of the magnitude of something like this. As we were talking about earlier, Intel's current market cap, even after all its declines, it's still a very large company, about $87 billion in market cap. Qualcomm, $190 billion in market cap. We've talked about that there would undoubtedly be a lot of sort of regulatory scrutiny of something like this. What do you think of this report?
It's really interesting and really exciting. This would be the biggest deal in the history of the semiconductor industry ever. It also, so right there, a full stop. Intel was once the largest semiconductor company in the world. It is no longer. And Intel's struggles are really amazing. I mean, this company had an operating loss last quarter of $2 billion. So they are in a world of hurt and trying to figure out what's going on with their business. They are still very much wedded to selling chips into PCs because their business of selling chips into the data center has just not worked out. They've missed so many product cycles with NVIDIA cleaning their clocks in the data center, and that shows no sign of any immediate change. Now, they announced a really big deal, a multi-billion-dollar deal with Amazon this week that gives them hope that maybe they're going to be able to get some of their semiconductor manufacturing business into a better place as they build out facilities all around the world, especially in the U.S. But when you think about these companies, you've got to think about Intel having things that Qualcomm really doesn't have. It's got manufacturing prowess. It's got a place in data centers and in PCs. Qualcomm has some plans around PCs, but Qualcomm is largely a smartphone company. Most of their business is making chips for smartphones. They've got an IoT unit that's shrinking. They've got an automotive unit that's also not doing great guns right now. But I think 73% of revenues last quarter were in smartphones. And so that is something that Intel's famously missed out on for decades now. And it would be an interesting combined company that would have this strength in manufacturing from Intel, in PCs from Intel, maybe data center at some point for Intel, and then smartphones from Qualcomm. It's also interesting because Qualcomm historically has not made their own chips. They and owned a lot of facilities to make those chips. So it would be a change in philosophy, or there's a spin-off potential here. So it's a really fascinating notion.
Corey, how do you think regulators in D.C. would react to this idea?
So I think that there's we certainly have got a very strong antitrust regime right now in Washington, and opinion. I think it's a good thing. We don't want monopolies. Monopolies hurt innovation. They hurt small companies trying to change the world, make the world a better place. But we really need a strong chip industry in this country to fight against the risk of the concentration we have in Taiwan. And so something that would help Intel survive and do better, which this merger might be seen as, might be welcomed by Washington. So I don't think that this is instantly the kind of thing, because they're in different markets and because we want both of these companies to do well, it is in our national security interest for that to be the case. I think this would have a shot.
It's interesting because if you look at the stock reaction for these two companies, yes, you saw sort of a rapid reaction here, but it's not. I'm going to just put my little armchair, analysis hat on. At the close, Intel was up 3.3%. That to me does not say people said absolutely this deal is getting done. And so I guess and again, this was a very preliminary report. Do other suitors come out of the woodwork and offer to buy Intel too?
Right.
What do you think happens next?
Well, what does Broadcom do, right? We know how much Hock Tan likes to gobble up companies, having just done that massive deal with VMware. But I think that, like I said, this is a really interesting potential combination here. But the value of Intel, if it's on sale now, it might be on sale more after next quarter. I mean, Intel's got issues, and you're buying a whole heap of troubles if you buy Intel, whether you're buying the stock or Qualcomm buying the whole company. Now, it's a consultant's dream, right, to be able to walk into Intel and try to fix this business and make it work. Intel also has a really unique culture. And one of the facets of that culture is people have worked there forever. I remember visiting a factory or a fab up in Hillsboro, Oregon, and the person who was bringing me around had worked at the company for 15 years, and she told me that she was considered the new girl. And that told me a lot. It told me not just that 15 years is a short tenure at Intel, the fact that she would be referred to as a girl, and that this sort of stultified culture of Intel is still very much a part of Intel. And it's not as simple as looking at what's on the balance sheet and seeing that that's what you're going to acquire, or looking at the customer list and seeing that's what you're going to acquire. There's also a really unique Intel culture that is still there. And I think that that's another reason why a deal like this would be hard to integrate, but again, a fascinating concept.
Corey, you look at this, this stock. I mean, Intel has just been smashed. It's down about 60% this year. I'm just curious to get your take. You think about Pat Gelsinger, and in Gelsinger's defense, listen, he always said it when he first came on board. He laid out this strategy, and it was going to take years to play out. He was clear about that. I'm just curious. You know the company. You think about the landscape. I mean, what do you make of Gelsinger's job as CEO?
Yeah.
What do you make of his strategy?
And I also have a fond place in my heart for the company. I really care about this company. I think because of that culture, because of so many people I've known there over the years that work there, and I want the company to succeed. But Gelsinger has been through a number of plans over his tenure at Intel. He was a brilliant designer at this company. He left to go to VMware, of course, and then came back to Intel famously. But these guys got to move fast. They got to change a lot. But designing semiconductors and changes, Intel usually moves in a not a glacial pace, but the kinds of decisions they make take a decade to play out. The building of a fab can take 8 to 10 years and billions of dollars. So it's not the kind of business you can turn on a dime, despite the best McKinsey consultants out there that might want to see that happen.
Corey, thanks so much for hopping on. Really appreciate it.
Glad I could do it.
Stick around. We got more market domination overtime coming right up.
During his decade in politics, former President Donald Trump has often enjoyed an edge over Democrats when it comes to handling the economy. Well, maybe not anymore. Joining us now is Yahoo Finance's own Rick Newman. Rick.
Hey, guys. Yeah, a lot of polls recently showing that Kamala Harris is really closing the gap with Donald Trump when you ask voters who they trust the most on the economy. So the Financial Times poll was one of the first to show this back in August, and it was kind of an outlier then. But they did it again, and in the latest version of that, Kamala Harris actually ahead of Trump on her handling of the economy by a couple of points. Morning Consult had a poll. Trump and Harris basically tied on the economy. There's a Quinnipiac poll in Pennsylvania, which is a crucial swing state, again, tied on the economy. And the University of Michigan, when they do those consumer confidence surveys, there's a ton of data behind that. And they also find that Kamala Harris is tied with Trump or maybe a little bit ahead of him. So, this used to be Trump's biggest advantage, I think it's fair to say, one of the big advantages anyway, over Biden. And since Biden dropped out in July, Kamala Harris seems to have completely neutralized the advantage Trump has on the economy. And Trump's second strong issue is immigration. And that's not working as well for him either. Since the Biden administration clamped down on immigration, we have far fewer people coming across the border. It's not in the news, and people just aren't concerned about it somewhere. So it is still a super tight race. But this is a very intriguing development with more voters saying they trust Kamala Harris on the economy.
We had a really interesting conversation earlier with Jay Hatfield of InfraCap Partners, where he thinks that if there were to be a Republican sweep or a Democratic sweep, that would be a much bigger deal for economic policy, not because of tariffs or any of the other stuff, but just for the simple fact of a corporate tax becoming more likely in the event of a Republican sweep. We've talked, Rick, you and us, less about the congressional races and more about the presidential race. But obviously, the congressional stuff's a big deal. What's your latest thinking around that?
Yeah, there really are four potential outcomes here. It's that Kamala Harris wins with a divided government with Republicans partly in control, or she wins with a Democratic sweep and Democrats control, or the same with Trump. He wins with a Republican sweep or with a divided government. The least likely of those scenarios is that Harris wins with a Democratic sweep, and that's mainly because the Senate just looks basically out of reach for Democrats. It's a function of just they're defending a lot of tough seats. Even if Democrats get a sweep, this is something I think investors don't appreciate. That does not automatically mean that we're going to have a corporate tax rate. Joe Biden wants to raise the corporate tax rate. He campaigned on this in 2020 from 21%, where it is now, up to 28%. He couldn't do it. And Democrats controlled Congress for the first 2 years he was in office. I think it's going to be the same if Kamala Harris, if in that slow probability scenario that she wins a Democratic sweep, I think it's going to be such a narrow Democratic edge. I think they're still going to have a hard time raising the corporate tax rate. If you flip it around for Trump, the thing that worries people, economists, about Trump is the two big parts of his proposal he can do without Congress, and that's impose tariffs and start mass deportations. And those are the two things that economists really hate the most about Trump's policies. And those are the reasons you see a lot of forecasters. Goldman Sachs says the economy might do worse under Trump than under Harris. And that does seem to be breaking through a little bit to voters.
Well, we'll see what happens. But yes, good point about the various nuances of the different outcomes. Rick, thank you.
Bye, guys.
Bye. A big options expiration week, $5 trillion in options expiring in the latest so-called triple witching session that just concluded. That market event coming the same week as the Fed's decision to cut interest rates and an S&P rebalancing. So what's the best way to play it? eToro U.S. investment and options analyst Brett Kenwell joined us now to discuss in the Options Playbook, sponsored by Tasty Trade. Thanks so much for being here. So, we had this enormous event today. Now that it's done, what do we see over the course of the session that can inform where positioning was and where it may go from here, Brett?
Sure. Today was one of the big four expiration dates of the year for when it comes to the options market. And, I think you kind of saw that action leading up to today's session with so much back and forth. And we had a late day pop in stocks. And, that a lot of that plays into the expiration. But I think what's really interesting is when you look at the seasonality. So you look at seasonality in September, it tends to be pretty bad for U.S. stocks. And, when you really dial into that seasonality, you see a lot of it comes in the so-called back half of mid-month, which to, an options trader's ear, you hear the third week, which is, right around the monthly OPEX. And so, I think that leaves the door open at least to see some choppiness, some profit taking, or some outright seasonal weakness kind of going into the end of quarter. But, that's short term. That's the next, we have 10 days till the end of the month and, a few weekends in between. So it's really only a few more sessions. I think longer term, bigger picture, it still looks pretty constructive for equities.
Well, let's get down and get into some sectors, Brett. I know you expect strength in tech, for example. How come? Walk us through that.
Yeah, so, a few months ago, we were looking for strength from, some of the less loved, under-owned sectors. Utilities was a big one, and it's become a great performer, and a few others have done great as well ahead of the Fed's, finally they've cut rates, and, a lot of sectors performed well into that, and it's been great. It's great to see. It's healthy to see, improved breadth. It's healthy to see better market participation, more sectors joining the party, but, kind of tech has sort of fallen by the wayside amid all this, breadth expansion. Suddenly it's gone from, the favorite stocks, the leadership group, to being, I think it's the fourth or fifth best performer on the year, when it comes on a sector by sector basis. And so, the S&P and the Nasdaq, they all rallied really hard into mid-July. They topped out, and we've had good amount of volatility since then with, the carry trade imploding and whatnot. But, you look at the Dow, you look at the S&P, they've both found a way to get back to all-time highs. And you look at the Nasdaq, and it continues to lag. That's despite, many of these names being household names, despite being investors' favorite stocks, despite them being the biggest stocks in the market. And, I think in the fourth quarter, we probably see a little bit of a rotation back into some of these names and some of these, Magnificent Seven, large cap tech. I think they start to play catch up.
And so from an options perspective, what are some ways that people could get into that if they also agree that tech is going to catch up?
From an institution standpoint, early this month in September, we had that, I won't say minor dip, but it was certainly minor compared to the one we saw in early August. And into that dip, we saw a lot of, put sales into some of the Magnificent Seven names or a lot of the semiconductor leaders. I don't know that that's necessarily the best way for a retail investor to play. Probably a more reasonable way to play at this point would be, probably by either buying calls or if they want to reduce that cost and limit their upside a bit. Call spread would be a great way to get into it. Something where they have a defined risk. They know what they're, they know the net debit. They know what they're paying, and they're not going to lose more than what they put into it. So probably calls or call spreads would be a great way. And if they don't want to pick individual names, that's completely fine. You have the QQQ ETF. You have the XLK ETF. Both of those names should do well if tech picks up in Q4.
If you expect strength in tech, Brett, are there sectors where conversely, you'd be looking for weakness here?
I think that it wouldn't be surprising if we saw some of those, like utilities I mentioned earlier, or real estate. Both those names have done really, really well lately. I wouldn't be surprised if we saw a bit of a sell the news type of reaction in those names. But we have to remember, too, they were depressed for so long, and now we're seeing sort of these catalysts line up for them, and rates aren't just a one-off rate cut that we had on Wednesday. We now have a path to lower rates, and I do think we can actually keep some of this breadth expansion alive and keep some of these other sectors going, which is a great thing. That's what we do want to see. That we don't want to go back to the first half of 2023 where it's basically the Magnificent Seven and maybe Eli Lilly, the Magnificent Eight doing all the heavy lifting. We want to see a number of sectors doing the lifting, but we could see a sell the news reaction on some of the more the hot sectors lately.
Brett, always good to have you on the show. Thank you for joining us.
Yeah, thanks so much.
Time now to watch next week. Starting off on the Fed, we're getting a huge batch of Fed commentary throughout the week from multiple Fed officials. The Federal Reserve shocked many on Wall Street, cutting interest rates by 50 basis points on Wednesday, as opposed to a more conservative 25-point cut. And as the cuts impact ripples into the stock market, investors will listen closely for any clues about what the Fed's next move might be.
And speaking of the Fed, their preferred inflation gauge coming out on Friday. That, of course, is PCE, or personal consumption expenditures. Economists forecasting total PCE growth will slow to 0.1%, while core PCE holds steady at 0.2% growth. This will be the first big piece of economic data since the Fed's 50 basis point cut on Wednesday.
And finally, we'll be getting some more corporate earnings next week from Costco, Micron, and KB Homes, among others. Costco reporting fourth quarter results after the close on Thursday. Analysts expecting to see same-store sales grow, giving us more insight into the health of the consumer.
Well, retirement planning does not mean locking up your money for a rainy day and forgetting about it. Planning your future means reacting to events today. Yahoo Finance's new podcast, Decoding Retirement, gives you the tools to navigate those years ahead and take action now. You can watch Decoding Retirement every Tuesday at noon Eastern. Stay tuned. Asking for a Trend is coming up next. and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we'll be diving into. The Dow notching another record high to close out the week, and all of the major averages posting weekly gains thanks to the major rally Thursday after the Federal Reserve cut interest rates. Bitcoin, though, coming under selling pressure despite riding the week's everything rally. Crypto was among the key topics at this week's Future Proof Festival, where I caught up with Galaxy Digital CEO Michael Novogratz. Part of that conversation is coming up. And it's 5 o'clock somewhere. We're looking at what Americans are drinking. Tequila has been seeing sales surge in recent years, but those gains have slowed. We're looking at what's driving that trend. Well, August was a good month for the construction industry. It added 34,000 jobs and saw unemployment fall to a monthly record low of 3.2%. Of course, things can always be better, and that's the aim of our next guest. Joining us now, Maria Davidson, CEO of Kojo. Thanks so much for being here, Maria.
Thank you for having me.
So let's start with what Kojo does to sort of situate you in the construction industry so people understand where you're coming from. You guys are a platform to help construction firms sort of manage supply chains, et cetera. Can you talk us through a little bit?
Yeah, absolutely. So Kojo is the largest materials management platform in the US. We're a software company that helps more than 500 of the largest trade contractors process more than $3 billion a year of materials and make sure that they get them at the best price, delivered exactly when they need them, and know where all their materials are at any given moment.
So you have a good handle on what is happening in the industry, in other words. And so when we talk about what's going on the jobs front in the construction industry, demand is not the problem, from what I understand. It's the supply of workers, and specifically skilled workers, who are able to do those jobs. How has that changed over, say, the past year? What have you been seeing?
Well, right now, construction backlogs are actually at all-time highs. So you're exactly right. Demand is not the problem. The problem is that there are 600,000 construction workers that are currently missing from the industry. If you look at just electrical construction, we're going to need 1 million more workers to keep up with all of the demand over the next 10 years. And so what's currently happening is we have a huge labor shortage. A lot of the contractors across the country can't actually take on jobs that they're being offered because they can't find the workers to actually fulfill those jobs. And as a result, that's a problem that we've seen be extremely top of mind for people.
Why is this happening? Is it because people are not going into construction? Is it because people who were in construction have migrated to other industries? What's going on?
Well, there are a few things. One is that construction is not as exciting an industry for a lot of young people who see construction as an industry that's very manual, that hasn't embraced technology, and that honestly is outdated. Also, if you look at construction as a whole, only 11% of the workforce is female. And if you look at specifically the trades, so companies like the electrical, the mechanical, the concrete companies, only 4% of the workforce is female. And so I think construction specifically struggles with hiring a more diverse workforce. And the third piece of this is that without embracing technology, it's very hard for workers who are currently in the field to become more and more productive at the rate we need, given how much work there is with manufacturing, with data centers, with improvements in infrastructure that we're building.
So what kinds of, technology is where you come into the equation, obviously. Right. But when we're talking about stuff that is manual work, there's only so much that technology can replace there. So where are those opportunities, though?
A lot of the opportunities come with being very well planned. So knowing exactly what you need to order and knowing exactly what labor is needed to be scheduled and when. And for us, that's where we come in with helping people know that they've compared prices across materials, that they know that they're getting the best possible bid, that they can track in real time how they're doing compared to estimates. And that helps you avoid any of these last minute delays that can throw an entire project off, because if you miss something like a concrete pour, it might be another 3 months before you can reschedule the next one.
Something else I'm interested in, to go back to the idea that it is not a very diverse profession. When you're talking about commercial projects in particular that are government funded, some of those government contracts have certain requirements about what diversity the contractors need to have, correct? So how has that motivated the industry at all to try to bring in more diverse workers?
I think it definitely has. And last month was actually the first month where there were more than 1 million women in construction in the US, which is a huge accomplishment. But those types of projects are only a fraction of the total projects that exist. And especially when we look across the range of jobs that exist within construction companies, we're seeing that jobs in the field or in project management are still really underrepresented by women compared to jobs, for example, in office work or in management.
How do you think that gets changed? Or does it?
Well, I think number one is we've got to invest in making the workplace more appealing to women. And so that starts with offering policies like better childcare or more support. I also think it starts truly at high school with investing more in vocational training and doing things like career fairs where companies can come and present to high school students about the benefits of a career in construction. Because a fact that's not talked about is that in construction, the gender wage parity is actually one of the best in the US, and it is an extremely stable career to go into.
And you get paid a decent amount in a lot of these skilled trades as well.
Oh, you absolutely do, especially now that the shortage has meant that companies are really working the hardest that we've seen to recruit and retain the best talent that they can find.
Maria, thanks for coming in. Really appreciate it.
Thank you for having me.
Thank you. Well, stick around. We've got more Asking for a Trend still to come. At the Future Proof Festival in Huntington Beach, California this week, I got the chance to catch up with Galaxy Digital founder and CEO Michael Novogratz to discuss crypto ETFs. Here's what he said.
I want to ask you about some new products that you guys rolled out with State Street, Galaxy Digital and State Street teaming up to introduce more sort of actively managed crypto ETF products. Obviously, it's been a big year for ETFs within crypto with the cash products. What role do you see these serving, and what kind of demand are you hearing about?
Yeah, listen, the products are like a week old, off to great performance in 1 week. They're unique in that up until now, crypto's been just a long play. And now with as many equities as there are around the space,
you're able to go long and short in these ETFs, use options to hedge, and not short in the ETFs, but long or short your index, use options to hedge. And so it really is an alpha product. And I think, teaming up with State Street, they've got $4 trillion under management. The sales force and the distribution network they have just goes to the overall crypto story. It's bringing more people into the tent. The portfolio manager, Chris Ryan, on this thing, he's awesome. He is a serious guy. He spent a huge amount of his career in equities. This will be, a lot of crypto equities. And so I think, will it outperform Bitcoin? Will it underperform Bitcoin? It probably underperforms on the giant bull markets and outperforms on the bear markets like most mutual funds. But I think it's going to bring a lot of new participants into the market.
And let's just talk about price action broadly. Let's talk Bitcoin, since, as you said, that is the dominant cryptocurrency. Where do you think we're going from here, and how binary will it be because of the election?
I think if you step back, Bitcoin is going higher because neither party wants to deal with the deficit. And I don't know who's going to be worse, right? You look at Trump's plans, they don't have any deficit reduction in them at all. The big bogeymen out there are Medicare and Social Security, which are just eating up more and more of our tax base each year. And until those are dealt with, we're going to print more money and Bitcoin's going to go higher. I think if Trump wins right now, you're going to get an extra acceleration. And we're not sure about Biden. I'm sorry, Harris. I do think there is a high possibility that Harris is going to have a perfectly excellent crypto policy. Maybe not as aggressive as Trump saying, I'm going to buy crypto for the balance sheet, but all we really need is for people to stop stopping us.
Well, let me ask you this, Mike, and I asked Tom Lee this same question yesterday of Fundstrat, who's a longtime Bitcoin bull as well. And I said, the thing about Bitcoin people is they always think it's going to go up, and they'll always find a reason that it's going to go up, right?
I'll give you a reason it's going to go down.
Right. What's the biggest risk?
The biggest risk, and as an American, I kind of sometimes would say, okay, it's okay to lose money in that first. If we have an administration that comes in and tackles our deficit, that if we have an administration that takes debt to GDP from 130% back to 80%, or at least heading in that direction, that says we need to raise taxes and cut spending, that we need to make our people more efficient, more effective, right? We need to raise productivity in this country, that governments aren't real productive, that we need to, reform Social Security and Medicare. If you had that miracle, Bill Clinton kind of got there, Bitcoin would go down, not up, right? Bitcoin goes up in the US and around the world because governments can't keep their pants on. They just can't stop spending money. And that's almost endemic to what governments do. And we're at this weird acceleration. We're adding $1 trillion of debt every 100 days.
So if I can just drill on that, and then we'll I'll let you go. Connect the dots for me. Why is that good for Bitcoin if there is this government spending?
Because if you think about, if the government takes $100 and just says, now it's $200, asset prices go up. So gold at the beginning of the year was $1,700, now it's $2,600 or $2,550.
So in other words, it's not specific to Bitcoin. Now it's broadly bullish for asset prices.
For hard assets, or things perceived as stores of value.
Right.
Real estate, right? You want to own property on Fifth Avenue if you think they're going to print a lot of extra currencies. Equities usually do well. Gold, I think gold's going to go to 3,000, and I mark my words, if governments don't change, gold will be 10,000 in 5 years. Some people are like, how did gold get to 10,000? We got to get 10,000 because your dollar becomes worth less. The euro becomes worth less. The yen becomes worth less.
Do you own gold as well as
I do
Bitcoin?
own gold, and silver, and a lot of real estate. And so I do think Bitcoin is such a better version of gold than gold, and it's a generational, like young people live in a digital world. They live on screens. 15 hours a day, some kids are on screens. And so it's a better version of gold. And as we see all these RIAs here, right, who are talking to the baby boomers with their $40 trillion of wealth, they will die. The great Charlie Munger passed away. He hated Bitcoin. I'm sure his grandson probably doesn't hate Bitcoin. And that money trickles down. And so as we go through this wealth generational shift, right, this wealth transfer, you're going to transfer from people that were scared of crypto to people that love crypto. And so, like, the tailwinds for the industry are really good. But the basic premise of Bitcoin, at least, is irresponsible governments.
All right, one more quick question. Do you have a price target for Bitcoin?
You know, I do think this year's interesting. If we get through this 73 area, then it's going to go a lot higher. It's going to take, I think the Fed's going to cut rates tomorrow. If it's 25 or 50, doesn't really matter because they're going to be really dovish. I think they'll go 50. That's going to set up a series of rate cuts. So it goes to the crypto narrative. And it's going to be around this election. And I think getting through the election and seeing if Trump wins, off to the races, and if Harris wins, what she comes out with her crypto policy. As long as it's decent, I think we take that high out and we're much higher a year from now.
All right, Mike Novogratz, thank you so much.
Thank
Really
you.
Appreciate it.
.818 Tequila, one of the fastest growing brands in a popular tequila industry, and the Kendall Jenner founded company is one of many celebrity-backed spirits companies trying to separate itself in a crowded field. Joining us now, Mike Novi, CEO of .818 Tequila and Calabasas Beverage Company. Thanks so much for coming in, Mike.
Thank you for having me.
Appreciate it. So, as I mentioned, it feels crowded in tequila land right now, and it feels crowded in celebrity alcohol brand land right now. So when you think about trying to set this product apart, sort of how do you go about doing that?
It is crowded, you're right, both the category and celebrity brands in particular. I think what we tried to do was be differentiated in that we weren't just going to be a celebrity brand. And when Kendall had the vision to kind of build something new that was going to fill white space in the category, what we did is we took a look at like taking her vision and putting that into a business plan. And fundamentally, it's 3 parts. It's all about having good times with friends. It's about quality craftsmanship, and it's about social responsibility. And I think because we are doing all 3 of those in harmony and in balance, we've actually separated ourselves from the pack.
And so how intrinsic is she also to the appeal of the brand?
Oh yeah, I think very intrinsic. I mean, for a couple of different reasons. One is that she has her fingers on the pulse of what consumers want. And of course, she's setting the trends of what consumers want. So one, Kendall's really important because she's constantly helping us kind of shift and move in terms of our messaging and our, kind of how we want to go to market and where we want to go to market. And so that's extremely important. Then, of course, there is the platform from which Kendall can speak to consumers. And those consumers are highly engaged with her and with our brand. And so all of that also, helps us kind of separate ourselves from the rest of the brands that are in the business.
Now, of those 3 things that you talked about, the one that sort of is not like the others, or that I don't necessarily automatically think of when I think tequila, is social responsibility. So how does that piece fit in?
So,
and what is socially responsible?
It's really interesting, right? So it's about giving back environmentally and societally in the markets in which we are made. So we're B Corp certified. We're one of the only, we're one of 2 tequila distilleries that's B Corp certified. We're one of only something like 7 or 8 distilleries in North America that are B Corp certified. So that is a big separator. And then we're members of 1% for the Planet. And so as a combination of that, there's like the whole conversation we could have just about how we take the waste products of making tequila, which are fundamentally a liquid and a fiber that's no longer productive for anything. And we've actually mixed that with adobe clay. We turn them into bricks. We bake them in the sun. We turn them into bricks. And then we fund things like the architecture, engineering, construction, and the materials to do things like build a library, which we've done in a community called Zapotitlán de Vadillo, Mexico, which teaches sustainable agriculture and has a 6-acre learning laboratory around it. So that's the sort of thing that we do in the area of social responsibility that's different.
Interesting. I want to take a step back and talk about the alcohol business, which is one that you've been in for a long time. Tequila sales have been rising. That growth is slowing a little bit. And then if you look across the beverage alcohol landscape, we've seen declines in some areas. Wine has kind of been slowing down. Beer has been slowing down. Spirits have been rising but flattening to some degree. So what do you think is going on as a veteran of the industry?
Well, I think there's shifting preferences on a macro level across alcohol in particular, what people want to drink within alcohol. People went from beer to wine to spirits. Like there's some of this is
and ready to drink. Of
ready
course,
to drink is a huge category and a huge growth driver in the industry right now. So there's that. It's just kind of like a maturation and exploration within categories, which as they move from one category to the other, kind of pulls people and consumers out of that category and shifts them into another, which is what we see kind of within the categories moving towards tequila. On another kind of macro consumer level, there's just a lot of competition for beverage choices. Now you have THC, CBD beverages in terms of kind of social beverages. There are different kind of views and health awareness undercurrents to all of this. So I think what we're seeing is that there's a continued growth in the industry to less but better. That seems to be, we go up and down in that as the economy kind of shifts and how people are spending money, but generally speaking, less but better. And people are more deliberate in the choices they're making. So better isn't just that it tastes better, but better is it's like a brand that does better.
Right,
it's something that has higher quality in every dimension.
Mike, thanks for coming in. Really interesting stuff. I appreciate it.
Thank you.
That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.